Okay, so I'd like to welcome everyone to the New York Alternative Investment Roundtable monthly call for April 2020. I am Robert Atkinson of Mirai Asset Securities Prime Brokerage. Today we are very pleased to have a distinguished industry veteran, Andrew Gitlin, president of PAMCO Launchpad and Atlantic Aligned Investors, share his views on the hedge fund industry, specifically where it's been, where he thinks it's going, and how startup, small, and emerging managers can attract seed capital. Just a few words about Andrew's firm and his background. PAMCO Launchpad is a hedge fund seeding platform that partners and co-invests with institutional investors to support the launch of talented hedge fund professionals. The Employee Retirement System of Texas is its initial partner on the platform. There are others. He has been a pioneer and leading executive in the hedge fund and manager seeding space for nearly 30 years. He began his career as the executive responsible for conceiving and launching the first U.S. commercial bank hedge fund at Chase Manhattan Bank, where he helped develop early due diligence techniques and identified emerging manager talent as far back as the late 80s. Following that, he became CEO of AIG International Asset Management, where he created one of the first large-scale multi-manager and seeding platforms and helped turn that into a multi-million-dollar business. After leaving AIG, he launched his own commodity arbitrage fund, which grew to nearly $1 billion in AUM in about 18 months. He subsequently partnered with the Dubai government to build an alternative investment business in the Gulf Cooperation Council and launched Prime Allocation Group to identify, fund, and nurture emerging managers. I learned recently that he's also an author of a book, Strategic Currency Investing. So as you can see, Andrew has had a very extensive and deep background in the hedge fund space as a corporate type as well as an entrepreneur. He's been an allocator. He's been on the manager side. So he is very well versed in this space, no question about it. So before we begin our Q&A, I do want to thank our sponsors for their support. As you can see on the slide in front of you, we have Alston Bird, Baker Tilly, Bloomberg, Deloitte, Grant Thornton, New Mountain Capital, Kaya, Department for International Trade from the United Kingdom, and the Grand Duchy of Luxembourg Trade and Investment Office here in New York. And last but certainly not least, our most recent sponsor, Mirai Asset Securities Prime Brokerage. So without further ado, Andrew, welcome to the New York Alternative Investment Roundtable. We certainly live in interesting times, don't we?
Oh, absolutely, Bob, and thank you for having me present or speak to you and your group. And without a doubt, we are sort of at another tipping point cyclically in the investment world and certainly in the hedge fund world, as you point out.
And Andrew, if I can, I just want everyone in the audience to know that if you're on the WebEx, in the lower right-hand corner, there's a chat box. So if anyone at any time would like to get a question to me, they can send it using that chat box. The other reminder is, please keep your phones on mute. That would be most helpful. So Andrew, when you and I spoke originally about this session, we thought it made sense maybe to break it up into three different sections. And in very general terms, section one might be your view of the hedge fund industry today. Secondly, you could talk about your thoughts on seeding and emerging managers. And finally, you could talk about how you approach the seeding process, what you look for in promising managers. Make sense?
Sure. Yep,
okay.
Absolutely.
So let's begin with the hedge fund industry today. What are your general thoughts on where we are today? What the challenges are, what the opportunities are?
So I think we're certainly at an interesting sort of crossroads in many respects. The hedge fund industry as a whole went through sort of a period of a 10-year period post-financial crisis where, you know, the sort of endless, ongoing, momentum-driven bull market sort of had the effect of making hedge funds increasingly seem like a less than ideal value proposition, particularly to institutional investors who make up the vast majority of dollars in hedge funds. And that was for a couple of reasons. One is because by default, on the whole, most sort of actively managed investments, whether they were mutual funds, hedge funds, et cetera, were generally underperforming the bull market on its rush to endless highs up and through our recent crisis. And so institutional investors increasingly get frustrated because they feel like they're paying fees and getting underperformance, notwithstanding the fact that the general concept of a hedge fund is not so much to beat the market on a regular basis as it is to provide non-correlated diversification. So we'll put that to one side for a minute. Now what we find is that we're suddenly in a period where the endless bull market momentum has gotten rattled by our current situation and the virus, and sort of passive investing, indexing, in-house investing on the part of institutional investors has proven a lot more challenging. The volatility has gone up dramatically. You know, a lot of portfolios have been beaten up, and suddenly the possibility that more active, more professional investment management may have a role in an institutional portfolio has come back to the fore. And it may very well be that we're in a period where capable, smart hedge fund managers, portfolio managers, actually bring something to the table now that's necessary for institutional investors as they try to realign their portfolios to take advantage of, or of the current dislocations and sort of extricate themselves from some severe underperformance. And so I think, these things come in cycles and in waves, and I think we're heading into a cycle or a wave where hedge funds become more relevant, certainly the ones that are effective and capable.
So, Andrew, as you pointed out, we've gone through maybe a bear market in hedge funds over the last 10 years, certainly since the financial crisis. What about supply of managers? Can you speak to that for a second? You're out there constantly looking for talented young managers or talented managers. Are you seeing, what about the supply of able managers?
Right, so good question. So sort of correlated to the 10-year period post-financial crisis, has been a more difficult environment for the hedge fund managers themselves. The cost of launching a business has gone up dramatically, and that's due to the regulatory and compliance requirements. That's due to the cost of technology, and ultimately the difficulty post-crisis that managers have had in raising capital to get launched. And that last piece, the difficulty in raising capital, is critical to the discussion because that's the result of institutional investors both getting a little sour on the hedge fund industry generally and pulling back, as well as the concentration in the industry where the money that has come in from institutional investors has increasingly gone to larger hedge funds, and that's made it difficult for the smaller ones. Conversely, though, with the imposition of regulations on the banking sector post-financial crisis, there are really fewer opportunities for portfolio managers and traders to find a home, right? Because the banks have largely pulled back from doing in-house speculation. The trading desks on the banks are less able to run pseudo hedge fund portfolios. And so somebody who's wanted to be in this business has had increasingly fewer options. They can't go to the banks. They could go to some of the large multi-PM desks like a Millennium or a Citadel or something like that. But otherwise, it's because, given how difficult it is to get launch capital, that has not been an easy pathway. So what that's meant for me is there's a lot of talent out there, and that talent is finding it increasingly difficult to find a home. And for me, that creates a perfect environment where you can find quality people who are having a difficult time raising money, and you can get involved with seeding for those guys. What has changed, though, and I think we should talk a little bit about the cycles, is, and one of the reasons why institutional investors, I think, got a little bit sour on the industry, is that during the big bull rush of hedge funds, let's say from 1990 on up through 2008, the crisis, the barriers to entry in the hedge fund industry were low. You know, if you thought you were a good trader or a good PM, you could march out there, and everybody was throwing money at hedge funds, so you could put a shingle outside your door and say you were a hedge fund, pay a few bucks to a lawyer to get some documents done, get $50 million or $25 million a launch, get started, get a Bloomberg terminal, and you were in the business. The problem with that, and I think the institutional investors have reacted to this, is you end up in this place where that so-called number where there's 10,000 hedge funds, everyone says, there's 10,000 hedge funds out there. The truth of the matter is 80 to 90% of those hedge funds should not be in the business. And there's 80 to 90% of those hedge funds are absolutely not worthy of any institutional dollars. And so as the institutions themselves went up the learning curve and went from sort of innocence where they didn't know much about hedge funds to the place where, let's say in the early 90s, they figured hedge funds might add value, but they didn't have in-house experience. So the best way to approach it was through fund of funds, right? And that was the big trend. And yes. Then institutional investors got smarter, and in the 2000s, they realized they didn't need fund of funds as much as they needed in-house experience. So they brought in hedge fund allocators and developed their own teams able to allocate inside the institutional investment world, where, you know, if you look around all the biggest institutional investors, they all have hedge fund allocation teams, and all those folks have CFAs internally. And so they started making direct investments to hedge funds. The problem is there were so many hedge funds out there who were under-skilled, inappropriate, or weren't really right for institutional investors that, you know, it created this world where the institutional investors had to slash through the weeds to try to find somebody who was really superior.
So Andrew, you've made a lot of really interesting points and covered a lot of territory there. And let me ask you this question. It almost sounds to me like when you look at the end of the spectrum that you're involved in, which is to say the startup, small and emerging managers, there might be two groups, okay? Group number one might be those managers, and I'll refer to them affectionately and respectfully as almost, you know, two men and a dog operating on top of a delicatessen. And that's the old model that we saw in the hedge fund business. It was almost heroic to go out on your own. You had some capital, friends, family, and fools type capital, and you start off with 10, 15, 25 million, whatever, okay? And as you and I discussed previously, you can have a very nice business if you raise $75, $100, $200 million. But that business may not be institutionalized, whereas the businesses that you're referring to are ones that set out to become institutional grade funds, correct?
Yes, that's absolutely the case. I mean,
and so what attributes do those funds possess? Again, and not to say that the former, there's anything wrong with that, because they can be very successful businesses, and they can serve a very useful purpose to all the stakeholders, particularly the investors, but they may not be institutional grade. But the ones you're talking about certainly are institutional grade. And I guess what comes to my mind, if you don't mind me, because I know it was disclosed in the news, you got behind the folks at Synctive, and of course I'm referring to Rich Schimmel and Larry Sapansky, and they've had a very successful launch, and I suppose you have, through no small part because of your efforts, but obviously they built an institutional grade business from day one, correct?
Yes, absolutely, and that is definitely what we look for and where we focus. And so, go ahead, Bob.
I was just going to say, so if you could talk about some of the attributes of those types of businesses.
Yeah, and so some of them are sort of tactile attributes, meaning they have a depth of team, they have a physical plant and infrastructure that can support their business, they have the people in all the functions that have the experience necessary to run a professional institutional asset management business. But then sort of the less tangible, if you will, aspect of it is, there's two sides to this. One is you, of course, are looking for folks who have the investment management, portfolio management skill set and experience. They know how to run money. They know how to manage risk. They have a sound strategy. But then the other side of it, and I think what lends itself to being more institutional, is that they know how to run a business. Because when you're looking to raise capital from institutional investors, you're talking about raising substantial amounts of money. Synctive launched with $1 billion, and we hope it to be a multi-billion-dollar product and business. But when you're running institutional money, whether it's a state pension fund or a sovereign wealth fund, behind those institutions are constituents, right? Behind a Texas employee retirement system are policemen, firemen, sanitation workers, the people, the backbone of our country. And it's their savings that you're touching and investing, and you have to treat that with the respect and the deference and the care that it deserves. And so I want to see folks who have the experience building and running a business as much as they have the experience building and managing an investment portfolio, because the two sides of an institutional hedge fund shop are the ability to build and run a portfolio, and then the ability to build and run a company, a firm. Because what makes up running a company and a firm is the ability to attract talent, the ability to retain talent, the ability to appropriately and adequately compensate them, the ability to manage the stresses of a company, the ability to manage the unexpected challenges and problems that rise in a business. So if you look at Synctive, for example, they started on September 1st in nice, shiny new offices over at Hudson Yards. They did clearly not anticipate that, 5 months later, they would have to evacuate effectively their premises and scatter their 55 people to the wind to work from home because we're social distancing, right? But interestingly enough, these guys had prepared for this and were aware of the challenges of working through these kinds of market stresses, including the fact that you saw an essentially depression-like collapse of the markets, right? So their experience and history of running businesses in the past and having experience with former companies gave them the presence of mind to manage through this. And not only have they been effective and successful getting through this, they've been making money every month. And so that's the kind of thing you're looking for to define an institutional business.
If I can just add on to that and really echo those sentiments, Andrew, my firm is affiliated with Korea's largest non-bank financial services company, and that firm runs, or at least one of our affiliates runs about $400 billion in AUM, and a growing portion of those assets are going to the alternative space. And I can tell you that the allocators at Mirae put a real premium on the operational due diligence side of their investigation of managers. So I think that that's clearly here to stay. And if I could just shift gears for a second and drill down on the issue of size and how that relates to institutions, I think you would agree that all things being equal, that alpha tends to be generated by smaller pools of capital, all things being equal. So
yeah,
how do you square that with institutions placing capital? Because institutions, of course, there's good news and bad news, and the good news is they have lots of capital placed. The bad news is they have capacity constraints, and it may be difficult for them to not only identify but stay engaged with a manager who's got a smaller pool of capital. So speak for a second about what it is that you do that helps those institutions to work with smaller managers.
Right. So if you step back and you start with the premise that, the vast majority of the money that's in the hedge fund world, pick a number, call it 75%, whatever, is institutional. And by that I mean, entities that have $5 billion or more to invest. And the first hurdle is that, by and large, most institutional investors have a fundamental rule that they can't be more than 10%. They can't represent, as an investor, more than 10% of the underlying fund's capital, right? So if you start with that premise and the premise that most institutions, as you said, need to maximize the work and the due diligence they do on a manager with a sizable commitment, because, as you say, they've gotten to a place where they can't have 300 investments of $20 million each in hedge funds. It's too hard to manage. So what they've determined, by and large, is they're going to have fewer managers with bigger investments. What it means is they do a lot more work and a lot more due diligence before they make an investment. But what it means for managers is the catch-22 of, how can I get institutional money if I've got to have at least a couple $100 million before they'll look at me, if not more? And that is the complexity of all of this. But so in my case, when we look to invest and partner with a manager and seed or launch an emerging manager or support an emerging manager, we come from a place where we're typically going to write tickets to get them started of at least, I'm going to say, 125 to 150 million, depending on the manager. And in addition to that, we're going to work with that manager to get other day one investors lined up with people that we know or who we've talked to. So if you look at the marketplace, a hedge fund typically isn't going to be attractive to an institutional investor unless they're at least 500 million. And then going back to your other point, because managers tend to lose a bit of their edge and their fluidity and their ability to move quickly in the market.
They're not as nimble.
The nimbleness, when they get up much over 5 or 6 billion, our view of life is we're looking to seed managers who will grow to anywhere from 3 to 6 billion. And we sort of want to max out around there, depending on the strategy, obviously. Some strategies have greater depth than others. The issue being that once managers who start getting to $15, $20 billion and up, there is a bit of mean reversion that takes place where they start looking a little indexy, and we are trying to avoid that, and the institutions are trying to avoid that. So it makes emerging managers more attractive. Don't forget that when an institution partners with someone like us to invest in an emerging manager, they also pick up the benefit of a revenue share. And that revenue share can be very powerful in adding to the overall IRR.
So Andrew, why don't you talk about that for a second? I think that you're onto something very interesting. I think the audience might find it useful to know how that process all works.
Right. So most of the white papers that are out there tend to show that an emerging manager or smaller managers, that is a manager, let's say less than 2 to 3 billion, will typically outperform on average larger managers somewhere between 200 to 300 basis points on average per year. Obviously, the data doesn't go back 100 years, so we don't know how statistically relevant that truly is, but that's what the data shows right now. Now, when we work with an emerging manager and launch them, part of the arrangement and the reason we get fully behind a manager such as Synctive, which launched with $1 billion, is we're going to take a revenue share with that manager. And what's exciting about that is now everybody's interests are fully aligned. We're fully supportive of the manager to make sure they succeed because that revenue share comes from the manager's success and growth. The managers obviously, incented to be successful and do its best, but the institutional investor now who's come to the party and gets a share of that revenue or, as part of that revenue share is also very supportive of that manager. And the value of that revenue share on average can be an additional 300 to 400 basis points on average. So when you look at the sum total of this, the advantage to working with and seeding emerging managers can be 500, 600 basis points or more on top of the typical underlying native return. And that can be very powerful if you know what you're doing and you know how to identify and manage these emerging managers.
Right. So let me ask you a follow-up question on that point. You talked before about, I guess, rising barriers to entry in the business. And the bottom line is the bottom line, right? They're manifested in higher costs to the manager, right? Whether it's technology-related, compliance-related, or even raising capital for that matter. You got to pay for this at some point. Now you talk about the benefits to the investor in terms of founder shares and being able to participate in gains away from the capital that you've actually contributed to the partnership, okay, which makes sense. And I just want to tie that in with, I know you and I over the years have had conversations about how the industry has very much been challenged by the fee structure. So I'm wondering, it sounds to me like if you net all this together, what's happening is, and layer one additional fact in there, and that is that passive investing has certainly been in vogue, and it's certainly been very competitive vis-a-vis active investing. It looks like it's the managers, okay, have had to rethink their fee structure, and the fee structure is far less attractive from a manager's standpoint. Would you agree with that, all things being equal?
Look, I certainly think the fee structures have come down, and the institutional investing community is definitely pushing for a much greater value proposition, and that has been effective. And so certainly the fee structure that managers generate has come down. When you get involved with early stage managers and emerging managers, you're definitely going to negotiate a much more rational and fair fee structure for the institution that's putting in that first money. So if you look at, and I think you hinted at this, if you look at for an institution thinking about emerging managers and working with somebody who knows what they're doing in that regard, the value of the founder's fee class, if you will, or the lower fee structure as the seeder, plus the value of the revenue share, what that has in total, the benefit of is virtually offsetting the total fee structure. So it's not specifically designed to do this, and we don't make that comparison, but in reality, an institutional investor that acts as a seeder with an emerging manager, where that manager does what they're supposed to do, you generally get a net result to the institutional investor where they're getting the native returns without any fees because of the offsetting revenue share and lower fee structure.
Okay.
So, but for the manager, now going back to sort of the core of your question, I guess, sorry, the managers are definitely getting lower fees and they're seeing less income. But I think the reality of it is, and let's be honest all amongst us, is managers have been, by and large, really overpaid in many respects for what they're doing. And I don't think what's going on now is unfair to managers or is really any less lucrative than any other occupation they could be doing. So yes, it's not the gold rush of the 90s or the early 2000s where, you know, managers were dictating fees, but I think you're seeing a more rational industry that's professionalizing. And as the industry professionalizes and rationalizes and institutionalizes, the fees are getting to a place where the value proposition, i.e. the fee for what's being delivered to the institutional investor, is becoming more realistic and more in line. And that's what you need. You need a fair value proposition and an alignment of interest for this industry to survive and grow. And I think that's what we're getting.
Yes, yes. I guess in some ways, and there's probably none of us on the call that were around for this, but back in the 70s, they had May Day. I guess it was May 1st, 1975, when we went from a fixed commission rate to negotiated commissions. And a lot of people at that point thought that if you went to negotiated commissions, which almost always suggested lower commissions, far lower commissions, it would destroy the brokerage industry. In fact, the opposite happened. The brokerage industry exploded in terms of growth. There were more opportunities to make money, and I guess the trend that you're describing here might be similar for hedge funds, that as those rates become more, or the fees become more market-driven based on supply and demand, there'll be opportunities for the industry to grow, to attract more capital.
Yeah, I mean, the more, and this is a phrase you'll hear from institutions, whether they're sovereign wealth in the Middle East or huge public pensions in the U.S. or Canada or Alaska or wherever, the more you deliver to the investor a fair, value proposition, meaning what you're doing and the results you're providing are in line with expectations and the fee for that is reasonable for what you're doing, the more institutions will invest and the better for the industry. Absolutely.
Yes, yes. What you do and how you do it, what struck me as being very useful to institutional investors is that your entity, and I believe you have basically 100 or so professionals at PAMCO Launchpad, and one of the things you do is take the trades in from all the managers that are on the platform, and you perform analysis work on that activity, and you share that information with the institutional investors. So in a sense, it frees them up from doing the work directly with the manager. They can rely on you to do a one-to-many type sweep as opposed to them doing one-to-one across the board with many different hedge funds. Is that accurate?
Right, absolutely. I mean, one of the difficulties for institutional investors we've seen over time to actively engage with emerging managers and not just talk about having an emerging manager program, but actually put money out into emerging managers, is just the difficulty and the challenge, both in terms of infrastructure and operations and actually expertise of identifying the right manager to partner with, as an emerging manager. And then how do I do the work to make sure that emerging manager who's, either early stage or startup even, how do I make sure they're doing what they're meant to be doing and are operating in line with our agreements and understandings? And that part can be tricky. And so that's where sort of my partner, PAMCO, which has a business built entirely on managed accounts and trade-by-trade processing, adds tremendous value because they sit in the middle of between the prime brokers where the trades are processed and the institution who's made the investment, looking at every trade, processing those, doing the risk oversight, and giving me the kind of feedback and reporting where I can talk to our partners and our managers and be sure that they're doing what they're meant to be doing in terms of strategy, risk limits, leverage, all the things that go into an agreement.
Sure. So talk for a second, Andrew, about how you actually identify and select potential managers.
Right. So that's part of the sort of the magic sauces or the magic fairy dust, as they say, I guess. So there's I always say there's two halves to it. There's the art and the science. The science of it is the more obvious stuff, and frankly, in many respects, the more perfunctory or more structured side of it, which is that you're looking at track records, you're looking at experience and CVs, you're looking at what people have done, where they've been, you're checking references, all of that fun stuff that's on the surface. The more art side of it is spending time with these people to understand what their motivation for having their own business is, what their skill set in managing people is, what their history of been dealing with crises and unexpected events is, what their interpersonal relations look like. If we're talking to somebody who wants to launch their own fund and let's say was the number 2 or 3 on a desk at some other fund, we want to talk to all the traders, the PMs, the support staff that have worked with them previously in different organizations and understand what kind of person this was. Was this person a good person to work with? Were they difficult? Were they open-minded? Were they supportive? How did they handle stress and pressure? It's the stuff that in many respects, a lot of this is the same stuff you would identify and look for in any entrepreneurial investment. If you were an angel investor or a venture capitalist, aside from the product or service that you're looking to invest in, you're really investing in people. That's sort of my fundamental argument.
So let me ask you,
go ahead.
I was going to say, do you get mandates, or are you just out there looking for, let's say, the best athletes, the best investors? How does that all work?
So it's a good question, and it's actually sort of both. So we are always, it's sort of my ongoing mission to meet with and get to know potential emerging managers, folks who want to start their businesses, and I'm always hoping to get introduced to or get input from the industry about who those people are and get to know them and talk to them, just generally across the board. Then more specifically, institutional investors I work with will often say, look, what we're specifically looking for is finding somebody who is focused on X, Y, or Z, and does something in the following way, in which case that may be a more tailored sort of assignment. But what we try to encourage institutional investors to do is think of the emerging managers and seeding as a standalone opportunity and a standalone sort of process where what you really want are the best of the best. You want to seed and invest a manager who is smart, competent, capable, experienced, driven, focused, and you think can run a good business, and almost regardless of what their strategy is within reason. And so a lot of institutions accept that prima facie, and others are, well, that makes sense, but I really don't want an incremental, fixed income manager or an incremental, long-short manager. I want somebody right now focused on distressed, which, by the way, is something we hear a lot about these days. We're getting a lot of that. So
okay. So let's just take that last point and go forward. Are there any strategies today that you think are more interesting?
Well, there's a funny enough, and it's a good question. There's a lot of activity in the business right now. Things have really heated up. I have gotten so many inbound calls from institutional investors, and those calls break down along two lines. One is from large institutions who maybe I've been talking to over the last year or two or three about getting involved in emerging managers or thinking about how that fits in their portfolio. And those institutions are saying, look, we've been thinking about it but haven't wanted to pursue it because, quote unquote, we haven't really needed to, right? We've been in a continuous bull market. There's been very little volatility. It has not been that difficult to make money in the market, so why do we need to go in the direction of trying something new with an emerger? So, and now, given what we've just lived through and what we're going through right now, we're rethinking our entire portfolio, we're rethinking our entire allocation strategy, and trying to figure out how we're going to reposition for the next few years of volatility, of shifts in the market, of, maybe a shift in momentum, maybe a cathartic shift in a lot of industries that are having issues, and how do we take advantage of that long term? So that's definitely occurring. And that's a real strategic shift in portfolio and thinking, and that's been refreshing to see. And I think that's going to continue. Secondly, are the phone calls that are much more opportunistic and are very, sort of short to medium focused, which are about, hey, we see dislocations in various markets, whether they're in rates or fixed income or in distressed or capital structure issues. We see lots of dislocations right now, and we think those dislocations will last for another 6, 12, 18 months. We want to take advantage of those, put money to work, and those are much more of the co-investment questions where they're like, look, do you have a manager who focuses on X, Y, and Z, and we could, put $500 million or $200 million into a specific trade, into a specific transaction. Is there something we can do there? And there's a lot of that going on, and we've been very active talking to managers who are in those spaces and telling them that this is a great time to develop relationships with new institutional investors or expand the depth of their relationships with their existing investors by finding specific opportunities where they want to go heavy and want to go deep outside of their existing fund or portfolio, and where we can put together those institutions with those trades. And so there is quite a bit of that going on right now all over the market.
That's very interesting, very interesting. How about, Andrew, lockup periods? What are you seeing there? So again, you described a candidate for your program as being someone, I think, who has at least $500 million in AUM, right? So that would be, let's say, the bar for an emerging manager. So an emerging manager is introduced to a institutional partner, and they write a nice ticket, a $100 million ticket. What would the terms look like on something like that in terms of lockup period?
Sure. So when I refer to the $500 million, just to be specific, they're not managers who necessarily have $500 million today, but that managers who will quickly be there either through our seed investment along with some other day one investors or something like that. But that's institutional investors who are not day one or day two will generally find it very difficult to just do normal investing with hedge funds who are much less than $500 million for the reasons I just explained, which is not being more than 10% of the portfolio. Yep. Therefore, at $500 million, that's a $50 million ticket, which from most institutional investors is typically the low end or sort of the number at which they're going to start. Now, in terms of the question you just asked, tell me the question again, Bob.
The lockup period.
Oh, the lockup period. Sorry. Yeah. So if you're a seed investor, if you're an institution who's going to get involved with an early stage manager and get a revenue share for sure, there's going to be a lockup period, and that's necessary both to support the manager A,
Yes.
B, to let other day two investors know that this is, as I referred to before, is actually an institutional quality manager. Why? Because there's capital that's been invested for a long time that's going to stay. And 3, to attract other investors and staff, right? If
Yes.
you're looking to build a business and bring quality PMs or traders or analysts or software developers into your company, they want to know you're going to be around for a while. The best way to make them comfortable with that is to let them know that your investor, your early stage investor, is committed to the business for a long period of time. And that's anywhere from a minimum of 2 all the way up to 5 years.
Okay. Very interesting.
So 2 is the short end, and 5 is what most managers would love to see.
I see. So I'm getting more questions in from the audience, and here's one.
Sure.
What are you seeing, Andrew, with respect to digital assets and Bitcoin? We spoke a moment ago about strategies that might be in vogue these days. What are you hearing? What are you seeing when it comes to digital and Bitcoin?
Yeah, I mean, that comes up a lot. We have really found, we have not, we keep an ear open to it because we're open to everything, but we have not really found a situation there that meets all the criteria of being an institutional investment as a strategy or as a hedge fund. And so we've not done anything in that world. We also find that the institutional investors we deal with, the larger ones, the institutional investors of 15, 20 billion, 100 billion, 200 billion, it's just not where they want to put their chips in terms of sort of liquid investing or a hedge fund investing. Whereas the large institutional investors we deal with look at digital assets and things like that and digital currencies as something that they will approach through their venture capital investment arm. You follow? So
yes.
They see that as a different opportunity. They'd rather get involved in the companies and the businesses that operate in those areas than see that as a hedge fund trading strategy.
Okay.
So, yeah.
Go ahead.
No, that's, yeah.
Okay, I got another question in here regarding corporate governance. Can you speak to that for a second? How does that all work when an institution comes in to the picture?
Well, that's a great question, and that speaks really to what I talked about, the depth, professionalism, and strength of the organization that an institution looks at as being representative of something worthy of their capital. And governance inside the organization is something we spend a lot of time on. How the organization operates, who's in charge of what, how decisions are made, what is the decision-making process, who has authority over what part of the business, where is the redundancy in the organization to make sure that things are handled properly, what external and outside firms are looking at them, accounting firms, compliance firms, legal, who are their counterparts in terms of prime broker, in terms of operational assistance. That is a huge thing. Now, one of the advantages and one of the things institutional investors look to me and my group to do is to actually assist the emerging manager in building that capability, right? So the good news, so the good news to all of this is while the level of expectation regarding corporate governance and infrastructure is very, very high, we don't necessarily assume that emerging managers have that skill set in place on day one. And we bring that to the table. So we will work with the manager to build and develop that through our infrastructure and our skills and our capability, whether it's creating an operations manual, whether it's creating an emergency manual, whether it's creating a redundancy manual, whether it's making sure they're hiring the right people for compliance, for risk oversight, for legal, and the right external people. So that is part of what an institutional investor will expect us to do, is make sure we get that emerging manager to a super high level of sort of corporate readiness.
So in some ways, the role you play goes beyond identifying and monitoring the activity of the manager. You really are a consultant in many ways, right? You handle everything that's not related to managing the portfolio directly, all the business-related issues, whether it's real estate, technology, compliance, as you said, disaster recovery, et cetera, maybe even sourcing people.
Yeah, we get involved. Now, we expect the manager to stand on their own 2 feet and be their own company, but we will help get them there. One of the interesting things about this, and when you think about it, it sort of makes sense, is, for example, me personally, I've probably interviewed and hired more compliance people, more operations people, more legal officers than any single manager is going to have ever done themselves.
Sure.
Right? And that's true for PAMCO as well. So the notion that we can add value in developing those processes and finding those people makes perfect sense. So what generally happens is, while we're there to support and assist these managers get up and rolling, and support and assist the investors in making sure that their investment is properly protected, I often find myself doing a lot of the recruiting and interviewing, or at least participating in the interview process for all the key people that an up-and-coming manager might hire. Not necessarily the trading talent per se, although I have been involved in a lot of those meetings, but certainly all the infrastructure teams and support personnel and risk management people. I mean, we want to partner with a portfolio manager, an emerging manager who sees the value in this sort of collaborative process.
Sure, and I know you know this, but there's certainly been a lot of scholarly research and industry studies that suggest that, getting back to talking about the smaller pools of capital being able to generate high levels of alpha, but the challenge that smaller pools of capital have are what you just described, the business risk. And if you could somehow mitigate the business risk of these smaller managers, emerging managers, they could even be more successful and more successful at attracting capital. And so it sounds like that's something that you folks, a role that you play. You help to mitigate business risk for a lot of these managers. And that's part of the value that you bring to the institutional investors.
You just said it much more eloquently and succinctly than I have in the last 45 minutes, which is that, and I thank you for that. And there'll be some fresh bagels at your door tomorrow.
Okay, but, I could use fresh bagels. I haven't had them in a long time. It's been 5 weeks.
Who couldn't, right? Right.
So it's like, I have another question from the audience.
No, but I just wanted to say
from the audience.
Oh, go ahead.
Sure, because time is becoming dear here.
Yeah, go ahead.
What about funds heavily involved in data and artificial intelligence and machine learning? What are you seeing there?
Definitely an area of interest. It continues to be an area of interest for us. It continues to be something large institutions have their eyes and ears open for. It's a very tricky trigger to pull. And we, if only because there's just not enough evidence yet to support the notion that these things, not these things, I don't want to, talk about the, broad brushstroke, but that any specific sort of strategy or any specific, quantitative developer has it just right, and it's hard to know, right? So the point I make is that we're not in a position to look at somebody's source code or somebody how many factors somebody has built into their model to know that they got it just right, and therefore become able to assess that this is the right person to get involved with or the right strategy. Look, we definitely believe that there's aspects of investing that a computer, a good system, good AI, good neural net kind of processes can do quicker and more effectively than, let's say, an analyst on a desk. We just don't know if that quicker and effective means better. That's the trick.
Right.
You know, and it's hard to know how you tend not to know until after the fact. And we've certainly seen a lot of quants and quant strategies over the last few weeks take it on the chin, right? A lot of, you know, risk premia stuff, a lot of quant strategies, a lot of big managers who focus in that area have gotten beaten up because there's always that, left tail, right tail stuff. It's always that stuff you didn't expect, that you didn't program in. It's that one factor you didn't anticipate. I don't know how many AI models looked for a coronavirus scenario and were able to anticipate that. I don't know.
I guess the real good ones did. Hey, listen, before we go on, Britt, can I ask you to change the slide, please? There you go.
Oh, there I am. Look at me.
There you go. And so I just want everyone on the call to see Andrew's contact information. Okay, so if any people have questions or would like to reach out directly to Andrew, he's certainly covered a lot of territory here today. And I think one of the themes, at least that I've gotten from this, is that, Andrew, you're very interested in meeting managers. Particularly startups, small and emerging managers. You're always out there looking for talent. And the other theme that I think I got from this, while there might be some strategies that are perhaps more relevant for the times we live in, you're very open to really meeting managers that all kinds of managers. Am I right, Andrew?
Well, yeah, managers who certainly would meet the criteria of having an institutional quality about them for sure, but we're equally looking for every day, always, institutional and other investors who want to participate in this sector, because the lifeblood of the hedge fund industry is, in fact, emerging managers, keeping the pipeline of talent full, but the lifeblood of emerging managers is always finding institutional and other investors who are prepared to work with us or someone like us to support them with capital. So I'm always looking for talent and managers who could be institutional quality, and I'm always looking for investors and institutions who want to partner with us to take advantage of this opportunity.
Excellent, excellent. And in the remaining time that we have, Andrew, I'm going to invite you to make any closing comments that you'd like to make about the industry, about how folks on the call might be able to reach you, anything that you think is relevant at this point.
Sure. Well, certainly I appreciate everybody being on the call and listening in, and I am open and happy to take emails and talk to people about any aspect of this, and questions, queries, suggestions, comments. You can use my email address right there. And I would just say that I think, the hedge fund industry is, I think, coming into another, really positive period of time where there is value that can be added through hedge funds. There is diversification and non-correlated performance that institutions and investors are going to find very valuable as we go forward, and taking advantage of the disruptions and dislocations. And I think emerging managers are critical to this and are the lifeblood if you know how to do it right. And there is an experience set and a capability that you want to bring to the table that we're happy to share. So I do appreciate everybody.
Excellent,
and I appreciate you, Bob, and thank you.
And well, Andrew, on behalf of the New York Alternative Investment Roundtable, I want to thank you for giving us your perspective on the industry, where it's going, and how PAMCO Launchpad is involved in it. I think this is, you certainly have not disappointed. You did a great job. Thank you. And to everyone in the audience, we want to wish you safety and security to you and your family, and look forward to seeing you on the call on future events. Please check your calendar. I know that we have some exciting things coming up in the near future. So on that note, I want to say have a great day and see you next month. Thanks again, Andrew.
Thanks, everybody. Thank you.
Bye now.
Bye-bye.